Accruals and prepayments are not complicated, but they are constantly wrong in practice. A misclassified accrual can misstate both profit and net assets simultaneously, which is why auditors test them every single year. In this episode, we go back to first principles, build the mechanics from the ground up, and make sure the logic is airtight. Everything starts with the accrual basis of accounting, which is mandatory under IAS 1 paragraph 27. The standard is explicit. An entity shall prepare its financial statements on the accrual basis of accounting, except for cash flow information. The conceptual framework reinforces this. Income and expenses are recognized when the economic phenomenon occurs, not when cash is received or paid. That one principle is the entire reason accruals and prepayments exist. So what is an accrual? An accrual arises when an expense has been incurred, or income has been earned, but no invoice has been raised or cash exchanged by the reporting date. You have consumed the economic benefit, so the cost belongs in this period's profit or loss. The credit side sits on the balance sheet as a liability, commonly called accrued expenses or accrued liabilities, because you owe a future cash outflow. A prepayment is the mirror image. Here, cash has gone out or come in, but the economic benefit has not yet been consumed. Paying 12 months of insurance on the 1st of October means 3 months belong in this year, 9 months belong in the next. Those 9 months sit as a current asset on the balance sheet, representing a future economic benefit the entity controls as a result of a past transaction. Let us look at how these two concepts flow through the financial statements. An accrual or prepayment starts with a transaction, creates a balance sheet position, and then either reverses on settlement or amortizes into profit or loss over time. The direction of that flow depends entirely on whether we are looking at an expense or income item, and whether cash leads or lags. Now let us work through a realistic example. Your entity has a financial year ending 31st December. On the 1st of October, you pay an annual insurance premium of 48,000 Rand for the period October through September of the following year. At year end, 3 months have expired. That is 12,000 Rand of expense. The remaining 9 months, 36,000 Rand, is a prepayment asset. Now the accrual side. Your entity uses an external legal firm throughout December. The matter is ongoing at year end and no invoice has arrived. Based on hours logged, you estimate the fee at 60,000 Rand. That cost belongs to December. You have consumed the service, so you must accrue it. The credit is a liability. Accrued expenses, sitting in current liabilities on the balance sheet. What happens in the next period when the invoice actually arrives? Many preparers accidentally double count the expense. The clean approach is a reversal. On the 1st of January, reverse the accrual entry. When the real invoice posts, it hits the expense account and nets to zero against the reversal. Alternatively, you match the invoice directly against the accrued liability, but only if you are certain the estimate was exact. Any difference between the estimate and the actual invoice is an estimation change under IAS 8. Recognized in the period the difference becomes known. Here is a bar chart showing the insurance expense recognized each quarter across the 2 financial years. Using our 48,000 Rand example, Year 1 picks up October, November, and December, 12,000 Rand in total. Year 2 picks up January through September, 36,000 Rand. The total is 48,000, matching the cash paid, but spread correctly across the periods that consumed the benefit. That is the accrual basis working exactly as it should. Balance sheet classification matters too. Under IAS 1 paragraph 54, prepayments and accrued receivables are presented within current assets if they will be realized within 12 months of the reporting date. Accrued liabilities sit in current liabilities on the same basis. If a prepayment extends beyond 12 months, say a 3-year software license paid up front, you split it. The portion reversing within 12 months is current, the remainder is non-current. Get that split wrong, and you distort current ratio and working capital metrics. The most common errors in practice fall into 4 categories. First, omitting accruals entirely. No invoice means no entry, which is simply wrong. Second, reversing in the wrong period, creating a double expense. Third, failing to split a long-term prepayment between current and non-current. And fourth, using a round number accrual year after year without refreshing the estimate. That is a change in accounting estimate under IAS 8 paragraph 32. The moment you update it, not a prior period error, provided the original estimate was reasonable. That last point deserves a moment. An accrual is an obligation where the amount and timing are substantially certain. You know the service was rendered, you are just waiting for the invoice. A provision under IAS 37 is where there is uncertainty about timing or amount, and you need a probable outflow test plus a reliable estimate. Do not reach for IAS 37 for a routine accrued salary or a utility bill. Save provisions for genuinely uncertain obligations like warranties, legal disputes, or restructuring costs. Let us pull it all together. Accruals and prepayments are the practical mechanism by which accrual-basis accounting converts cash flows into a faithful picture of economic performance. Get the direction right. Asset versus liability. Get the period allocation right, and get the balance sheet classification right. The conceptual test is always the same. Has the economic event occurred? If yes, recognize. If no, defer.